Good afternoon, everyone. Welcome to today's Procyon webinar. We know your time is very valuable, so we won't waste it today. We hope to cover 3 or 4 topics, really covering some accelerated investment trends around the COVID-19 pandemic. Of course, we know that there are a lot of investment trends that kind of go into this, but we thought that today we would try to narrow it down and share some of our insight. We have some guests as well here today. Let me introduce them. First of all, I'm Antonio Rodrigues. I'm a partner here at Procyon Partners. I serve as a senior portfolio manager here and the chairperson of our investment committee. We're joined by 2 individuals. We've got Mark Rich. He is a CFP and our senior financial analyst on the team. Hey, Mark, thanks for joining us today. Appreciate it.
Thanks, Antonio. Excited to be here.
You got it. We've also got Joe Dercy. He's the chief investment officer at Dynasty Financial Partners, one of our big partners in the industry. Joe helps oversee the 50 firms within the Dynasty Financial Network and covering almost $50 billion in assets. So we're lucky to have you, Joe. Thank you so much for joining us today.
Absolutely. Excited to be here with you guys.
Awesome. So we're going to give you some insight to the people watching today. We're going to give some insight into the Procyon Investment Committee, thinking about how we debate some of these topics, and we're going to hear a little bit from Joe on how Dynasty views this. But I'd first like to kind of frame this webinar a little bit. Investment ideas and trends, there's never a shortage, especially nowadays. And so we know that we're not going to be able to cover every last potential topic in terms of investment trends, but we want to at least give you some concise information around that. So we're going to do 3 or 4 topics today, and we'll just kind of kick it off here. First topic really, I think is interesting and kind of is large and comes and goes over long periods of time, is really the idea of anti-globalization or protectionism, as it were. So as a way to kind of frame what that means, that sort of hasn't come up in a while, at least for long periods of time, and it's quite obvious why. We think the efficient allocation of resources around the globe is the best way to get good outcomes. And so globalization has been sort of a symptom of that. However, what can happen, as we've seen now, is that pandemics, wars, religious beliefs, economic leverage, all of these, as they evolve, can really have a hand in creating anti-globalization as they occur. And so I think, what we'd like to see is some ways that we're going to pick out the actual specific issues with anti-globalization. We're going to talk a little bit about supply chains and costs and so forth. But I think if you look over long periods of time, over long periods of history, anti-globalization has come and gone. We've seen periods where countries, for their citizens, want to protect the borders and they want to protect their supplies and all that kind of stuff. And this pandemic is really not much different. So something more specific is, as we saw the demand for PPE and medical supplies really spike, including at very early on, ventilators and specifically, humans really didn't want to be reliant on other countries for those supplies, and we started to get this protectionist feeling, and so that influences a lot of things. We're very interconnected around the world as far as manufacturing and supply chains. And so, Joe, if you could, tell us a little bit about how Dynasty sees some of the disruption to these supply chains, how they're shifting, and maybe we can talk a little bit about that.
Yeah, thanks, Antonio. So as you mentioned, anti-globalization, it didn't begin with COVID, right? I think we were seeing that trend already. If you think about, the big issue before the pandemic, it was probably the relationship between US and China and trade disputes and labor issues and frictions. But I do think that the pandemic helped supercharge the trend. Certainly when the pandemic took hold, you talked a little bit about it, Antonio, some blaming on where the virus started. But also supply chains started to fray and to break. And, if anyone listening on the webinar can remember, at least for me, it was tough for us to even get things like toilet paper or hand sanitizer, right? At one point last kind of March and April. And of course, what Antonio mentioned as well, things, more important, PPE, personal protective equipment, and ventilators. So securing supply chains became, in that circumstance, a matter of national health and in some cases safety. So I think countries are going to begin to scrutinize their supply chains more so. Strategies like running lean inventories, or you'll hear the term just-in-time replacement strategies, they were seen to be vulnerable in the pandemic environment. So the review of supply chains, I think it was already underway, but the pandemic has accelerated it with trade wars and nationalism, protectionism, sustainability, human rights considerations. I was reading something last week the fashion brand H&M, at least for a period of time, they were actually totally erased from anything online in China. They have 400 locations there, but they had cut some production there for criticized China on human rights issues. The physical stores are still there, but if you go into their equivalent of Google and look it up, you won't find it. And if you go into their equivalent of Uber or Lyft, it won't even be, the store locations aren't even there for you to get to. So that's not necessarily a supply chain example, but I think it helps illustrate how a certain country can wind up influencing the companies in other countries as part of this broader topic. And so you combine the supply chain review that I think was already under review with the budding rivalry between the U.S. and China, and I think it's going to lead to governments having a more insular approach and focusing on enhancing domestic productivity and technologies and things that are critical. Rare earth metals or some of the other things that you hear about as well. I think you're going to see more localizing supply chains than we've seen over the past couple of decades. I think you'll probably see digitizing supply chains as well. Artificial intelligence, automation can create smarter and more flexible supply chains. So as Antonio mentioned, over the past couple of decades, I think the focus has really been on just the best commercial outcomes. Where can we get the cheapest production? But I think resiliency and adaptability is going to be much more in focus than they have been. And we've already seen China, starting to move away from just being the low-cost producer to countries like Vietnam and Mexico, but China still accounts for 60% of global consumer exports. So there's still a ways to go there. And I think just one other example, you saw, recently there's a shortage in semiconductors from a production perspective. They're used heavily in automobiles. You're hearing about automobile companies who, can't produce the amount of vehicles that they want to. Intel came out, which is an American producer, and it's just come out with plans to spend billions on making more capacity here within the U.S. And I'm sure the U.S. government is happy to see that as well. And the government has also tried to work with other producers to try to get locations set up here within the U.S. So I think a lot of these trends were underway, but I think certainly spurred on by COVID and accelerated by them with the blame game and the national security concerns that went along with it. And I think you're going to wind up seeing that more insular approach going forward. And Mark, maybe I'll pass it over to you to talk a little bit about how some of those things might affect costs, within the supply chain, and then how that ultimately can affect costs, in products.
Yeah, I think, and I want to piggyback on Joe, what you were saying for 1 second. And I think there's two main topics here. And one is really a longer term impact, and something that was started before the pandemic, and going back to the topic of this webinar, accelerated by the pandemic. So really, I think it comes down to two things: the quality of your supply chain and the diversification of your supply chain. And what happened during the pandemic is, early on, when China was really the only country to shut down, what you saw is a lot of companies that were tied to China in some way through their supply chain experienced those bottlenecks more significantly than companies that had more diversified supply chains. So I think taking that into account, when the pandemic turned into more of a global issue, it became more of all right, now everyone has these problems. So, let's work on getting ourselves fixed. And then coming out of this pandemic, we really need to address what we're doing from a supply chain standpoint. And maybe that's moving some of our production to more local, or maybe it's just diversifying so you don't have as much exposure in China, Joe, to your point. I think the other thing here in the slide that we pulled up is really more short-term impacts. And this is some of the comments that we pulled from the February version of the ISM Manufacturing Survey, which is a survey every month, basically from purchasing managers saying, how much are they buying? And the survey overall came back really strong in the month, shows that the economy in the US is in full expansion mode. But I think some of these comments are quite telling to kind of the short-term impacts that companies are seeing. And what we saw over the course of the last year is companies really reduced the amount of inventories they had on hand. And now, since demand's starting to pick back up and things are opening quicker, they're starting to fill, or they want to fill, those inventories as quickly as they can. And they're having trouble doing that because there are so many issues. And one of the major ones that Joe pointed out was the semiconductors was a big issue a month ago, and still continues to be. One of the newer ones tends to be in the plastics. It's difficult to get plastics, and one of those comments on the slide was from the chemicals industry, and they specifically pointed out the deep freeze in Texas as one of the main the main issues that they're having there, because that's one of the local producers of the chemicals needed to produce plastics. So, these issues can lead to, depending on how much of those costs that these suppliers can push through on the end to consumers, it might increase inflation in the near term, which I think is what we're seeing within the markets over the last few weeks. When interest rates are rising, it's really a reaction to inflation expectations increasing based off of these bottlenecks. Antonio, anything you wanted to add there?
No, I think trying to frame around supply chain issues, it's something that had been difficult in the past. Although over the last 12 months, I think we've all experienced it in a way that maybe we can put our finger on. Essentially, short-term issues of protectionism are shortages. But anytime, in economics, anytime you're influencing, the supply or the demand of something, you can have shortages, or you can have, you can have excess. So ultimately, that will influence prices. But I think you're right. Longer term, I think it's harder to determine what this means. But I think in economics, we generally believe that the efficient allocation of resources is the best way, and that kind of leads us down the road of back to globalization at some point. Moving on to the next topic, if that's okay, I want to talk a little bit about the most obvious trend, I think, which is the work from home, work from anywhere trend. We're right here. I mean, I'm in the office, but the truth is that we don't have to be anymore, right? So I think, it's an interesting trend for a number of reasons. I mean, we know the obvious stocks, right? The Zooms of the world and the Apples and the devices and the cloud storage. But I think, ultimately what we don't know is that, 20 years ago, that could not have happened the way that it occurred now. And the losses that were incurred and the damage in the economy, I think, would have been much worse. And so this work from home, work from anywhere sort of new idea is going to take hold in some sense. But of course, we want to talk about what that influences in the short term. It's heavily influenced, some travel. So if it's okay, what I think I'll do, I'm going to put up a poll here at this point and ask a question, and then we'll answer that in a minute. But it relates to this topic. So let's see. I'm going to actually launch this poll. This is an anonymous poll. So you can go ahead and answer that, and we're going to put up the results. It's, do you expect to be back in an office environment sometime in the next 6 months? Yes, no, not sure. And if it doesn't pertain to you, then maybe the question is more about someone that you're close to who's working from home. So I think it's kind of interesting to see what people are thinking. So Mark, if you want, talk a little bit about, the work from home as it relates to some travel, and then I'll put up some of these results when we get a second.
Yeah. And I think, speaking from personal experience, our role here, one of the great things about being in this role at Procyon is you have access to a lot of larger investment shops and a lot of meetings with various people at those investment shops. And before the pandemic, a lot of those were in person, and it was depending on who you could get at that time. What's different now is really we're still having these conversations, and I think they're taking place more often. But it's interesting to see just the different people that you can talk to within the different investment shops that we work with. So, you get higher up people in the companies, and you really get an in-depth look into the structure of these products that, we're investing in. And I think the other thing is just how efficient you can make these meetings, and you can pull in different resources, and you can share screens. And I think it's really increased the productivity of these meetings, and you can fit many into the course of a day. So I think just from personal experience, I think that there's an element to this that's going to stick around. I think that still, even when you look on TV and you're watching the news, you're more likely to see kind of a Brady Bunch scenario rather than people sitting around a desk talking. And I think really what it comes down to is just the different technologies that are out there and the full adoption that you had to make over the course of the last year, because you couldn't go 8 months without talking to somebody. So people really adopted these technologies, and whether it be Zoom like we're on right now, Microsoft Teams, WebEx software, all these work seamlessly, and we can have a conversation with various people no matter where they are in the world. I think that some element of that's definitely going to stick around. And there's been times in the past where people have said that business travel is dead. I think it'll be back in some extent, but I do think that the adoption of this technology and the efficiencies that people have worked out over the course of the last year, some of that's going to definitely stick around.
Yeah, I'm just going to put up the results of the poll here. So the question was, do you expect to be back in an office environment sometime in the next 6 months? And I think the results are what we expected. Ultimately, it's mixed, but more people than not do expect to be back in an office. And I think, that's really the advent of the vaccine and so forth. I think one of the biggest issues I'm talking to clients about who are in the Northeast, real estate holdings, right? And so what happens to real estate? I think that's one of the bigger questions that is yet to sort of be answered. We won't know that for some time, but I know, Joe, I wonder if you might talk a little bit around the real estate questions that we have in terms of the work from home. What does it all wind up being? Is the 2-hour commute going to be dead?
Yeah, I mean, look, obviously, flexible working arrangements were becoming a little bit more mainstream, but the pandemic has certainly accelerated the process as you talked about, because I think it proved to people that the technology can work and people can kind of settle into that environment and still be really productive. Certainly, it's going to have an impact on the entire office economy, if you will. I saw a stat from McKinsey. It said they estimate 20% of the global workforce could work the majority of its time away from the office going forward. And look, I think ultimately you'll wind up having, that poll was, do they expect to be back in the office? There's variation to that question then too, right? Which is, well, do you expect to be back in the office 5 days a week if you were before, or is it 3 days a week or 2 days a week, or, some sort of mix? And I think we'll certainly see a lot more of that. During the pandemic, we certainly saw, on the real estate market, deferrals, rent holidays, some tenant bankruptcies. Global commercial property investment volume fell by 48% in the third quarter of last year. Just yesterday, I saw a headline in the Wall Street Journal how JP Morgan and Salesforce are part of a growing list of firms that are dumping some of their office space. It said at the end of 2020, 137 million square feet of office space was available for sublease across the U.S. Because generally these commercial leases tend to be long. Sometimes they're 10 years. So you see a lot of people looking to sublease out. That number's up 40% from a year earlier, and it's the highest that we've seen since 2003. And then, retail rents have been hit hard as well, right? As more people shift to Amazon and other online venues. And I think we'll continue to see more of that. So, in short term revenue, there's been a hit. The bigger question remains around, longer term shifts of companies and how they approach, leasing and renting space. And I think the future of office space is going to be more of a blended model. Folks will need less space. People won't be in the office necessarily if they were 5 days, maybe it's 3 days. The commercial real estate isn't going away. There still is a need for people to congregate together, especially new hires within companies as well, to try to be part of the flow. So it's not going to go away, but and you've seen certainly some subsectors of the real estate market that have done well, right? Warehousing related to e-commerce, self-storage spaces, data centers, retail spaces that leverage grocery and pharmacy. And so, I think you'll wind up seeing some sort of hybrid. And I think you'll wind up having, though, a headwind in the face of commercial real estate on a go-forward basis. There's large migrations already happening out of Manhattan and San Francisco to states like Texas and Nevada and North Carolina and Florida that were looking for a lower cost of doing business. Anecdotally, my firm, Dynasty Financial Partners, we moved our headquarters out of Midtown Manhattan down to St. Petersburg, Florida in 2019. So before the pandemic. I think the pandemic will accelerate some of that. So certainly, into this year, we've seen sort of public real estate investment trusts, which were heavily related to commercial properties, performing well after a really tough year last year. But it's our view that the pandemic and the work from home phenomenon will be a headwind to those returns in the space in the years to come. And then just switching over quickly to the residential, aspect of it. We talk about companies that might move out of, some of those large city centers like Manhattan and San Francisco. Thousands of people are moving out of, the pricier urban areas. At least some part of that being because they can work remotely from a cheaper location, perhaps one that has better weather or lower taxes, whatever, the reasons might be. So I think we'll continue to see that
migration
as well.
Yeah, no, I think we would agree as well. I think what I think, you look, cities are not going to fall by the wayside ultimately, right? I mean, there have been plagues, there have been pandemics, there have been wars. People have left cities and humans want to come back. Humans want to congregate. That doesn't mean it'll happen in this generation though, right? I mean, ultimately, I think we're looking at, work from home, work from anywhere idea that can be broadened out, and depending on the company, it could work quite well. I think though, if we think about the idea of a work from home, we think about the real estate and some of the space. But there's still, and also the idea that there's higher productivity, as Mark was discussing, and I tend to agree. I know most people who are working from home or working from anywhere. You don't, you check your email right before dinner and right after dinner and right before you go to bed, and you're going to send something if you remember at 6 a.m. It's just the way that it is. So all of that data is continuing to be created. And so it needs to go somewhere, right? It needs to be stored. And so there's a few different things that also came out of this work from home, work from anywhere. And I think that's almost, socialized from anywhere in many respects. So if we sort of imagine the pre-pandemic acceleration of data and data storage, we know we've been in the information age for, a little longer than a decade. We also know that the flow of information is ever increasing. That was all happening before this hit. The COVID pandemic has now required us to take a large portion of all our future plans of that data storage and pull it forward. That's created not just, demand being pulled from the future, but also a broadening. My belief is that it's a broadening of the demographic. So demographic that is using these technologies and needs to store stuff, So if you can imagine, pre-pandemic, there were a lot of older and probably younger people who thought they would be able to leave this earth without ever having to video chat with someone, right? Well, guess what? You're not going to be able to leave this earth at this point without doing that. A lot more people are doing that now. And so that is data that has to go somewhere and get stored somewhere. And rightly so. So I think the other piece of all of that, as that continues to concentrate and that continues to be produced, and we've already started to see it, the now systemic companies that are in charge of this data, the movement of the data, the storage of the data, the generation of the data, they're now systemic. They've become systemic in our society, and they're going to need to answer for that and how they're going to be able to protect all of this. And they've already begun that, certainly in Washington. So I think while the work from home, work from anywhere thing is great, and we have these tools, I think we also have to know that we funneled massive amounts of capital into a fairly concentrated, set of companies who do a fairly concentrated set of things. And so from a regulatory standpoint, we're going to keep an eye on that. So I think work from home, work from anywhere is huge. Joe, I know it's hard to know whether it's permanent, temporary, transient, and so forth, but I wonder if, you had any sort of ideas around, I know you already think about, we know that some of this is going to be permanent. Have there been some estimates coming out yet from companies that have made plans? Is there anything specific that you think, you can talk to on the permanent versus temporary side?
Yeah, I mean, I think as we talked about on the real estate side, I think people are going to work from home more so, and I think there's going to be a headwind that we're going to see in the commercial real estate space for sure. We talked about the migration, out of some of the large cities for both companies and individuals, and I think that's going to continue. The shift to online usage, I think was happening already, and I think will continue to happen. And one of the things which we haven't talked about, but as we think about work from home, work from anywhere, kind of online, the shift to contactless payments will be lasting, right? This will benefit companies like Apple, Square, and PayPal. People literally didn't want to touch paper money during the pandemic, right? Given the fact that you can spread germs from it. And I think that kind of forced some folks who maybe were reluctant to that to really, just learn the technology and utilize it, specifically older generations. So nearly 1/3 of adults this is from Pew Research Center, said that they typically make no purchases using cash during a week. And I think millennials are leading that charge. And as those generations grow, I think that's going to wind up being a permanent shift, one that was probably underway already, but certainly accelerated by the pandemic.
Yeah, good points. And speaking of electronic payments, stimulus checks are on their way, right? Maybe touch a little bit on the stimulus impact. That's obviously an accelerated. I would say it's accelerating trends. Not that it's an accelerated trend. I don't know that stimulus is a trend, although it may be at this point. So if you wouldn't talk a little bit about that, that'd be great. Thank you, Joe.
Yeah, I mean, the amount of stimulus we think about from both a monetary perspective and from a fiscal perspective have been just enormous, particularly in the U.S. Dating back to the beginning of the pandemic last year. In a lot of cases, credited with certainly helping a lot of the metrics that we look at from an economic data perspective that we follow. I mean, for a while last year, it was like, is it going to be a V-shaped recovery? Is it going to be a Nike swoosh? Is it going to be, all the different types of letters and formations? And in a lot of ways, we've seen it be V-shaped, certainly the equity markets, but in a lot of the economic data as well, certainly one of the fastest downfalls, but then fastest recoveries that we've seen. And the stimulus that has come through has been a big help for that. So as we think about monetary stimulus, that really came in three categories. If we break it down: interest rate cuts, loans and asset purchases, and regulation changes really coming out of our central bank, the Federal Reserve. And so, from interest rates perspective, quickly brought short-term interest rates down to 0 to 25 basis points. Loans and asset purchases, I'll leave off a bunch here, but just to give you a sense of the amount of programs that were out there. I mean, certainly just general quantitative easing, where the central bank is purchasing securities, repo purchases to ensure liquidity, lines of credit to institutions, money market funds, the Paycheck Protection Program, right, to help small businesses, commercial paper funding facility, Main Street lending facility, municipal lending facility. I mean, the list goes on and on around the amounts of programs for loans and asset purchase that were out there. And then regulatory changes, just some technical changes that allow the Fed to hold less capital and lend more, and then relax reserve requirements for banks so that they can get out there and lend more as well. So just an enormous amount of monetary stimulus. And then, finally on the monetary front, just overall messaging from our Federal Reserve, which is saying that, they might be more open to allowing inflation to maybe run a little bit higher and not raise interest rates maybe as quickly as we have in the past. That's going to have some interesting effects as well. And then on the fiscal policy front, close to, 3 trillion in packages in March and April of last year, another 900 plus billion in December, the 1.9 trillion that just went through here in March. I mean, for things like vaccine research, money for state and local governments, unemployment insurance, direct checks to citizens, right? We were just talking about the stimulus checks, mortgage forbearance, hospital funding, schools and universities, child tax credits, support for airlines, student loan forgiveness. The list really goes on. JP Morgan estimated that the total global monetary and fiscal stimulus has totaled over $20 trillion, which is more than a fifth of global economic output. So the chart that I'm going to put up now, if you give me a second, will also show you that the stimulus has been very large in the U.S. compared to other areas within the world as well. Antonio, can you see that? Okay.
I can. Yep.
And so we can see here just the enormity of as a percentage of GDP within the U.S. as compared to the Euro area and Japan. And then if we look at this slide, just compared to how much, compared to the Great Recession or the Great Financial Crisis back in 2008, the 6.1 trillion that we talked about there compared to the 1.8 trillion coming out of the Great Recession, it's just an enormous amount of stimulus. So, hopefully that sets the backdrop for you. But Antonio, maybe I'll turn it over to you to talk about financial assets and state balance sheets, and the effect that might have.
Yeah, no, I think as we sort of frame it, looking back over the last year, the most immediate impact of the past stimulus was sort of the shotgun approach, right? So it was like PPP, unemployment, that kind of stuff, and massive liquidity as you described. And so obviously, very shortly after that initial stimulus and fiscal response, monetary response sort of occurred, the criticisms came in and it wasn't targeted well enough. And of course, we knew that at the beginning. And so I think now what's happening is, and we see this, is that the stimulus is being more targeted. And so I think that's good. It's going to reach the people that need it more quickly. That also allows us to draw some conclusions that we wouldn't necessarily have been able to draw before. But I think, the first piece is knowing where it's going to go. In terms of financial assets, what this has done, really all the stimulus, a lot of it, what it has done is, people get worried about inflation, as you should be if it is an issue, has risen. The inflation has shown up in financial asset prices, right? We saw the bottom in March and we saw the reinflation of all those assets within a very, very, I would say, short period of time, less than a year, 6 months or so. And that continued. And that was really the goal, I think, at the immediate onset. If the equity and bond markets were devalued at today at 50% less than it was, a year ago, we would be having a different conversation around where we need to go with stimulus. So I think the financial assets needed to be reflated in order to provide confidence. But I think one of the interesting things, more specifically about this stimulus, and Mark will, I think, touch on it, is around the specificity of it. But for me, I'm looking at something more specific: the state balance sheets. I think one of the bigger trends over the last 20 years has been state balance sheets have been in a tough spot. Unfunded pension liabilities, infrastructure issues. Interest rates were a little bit higher a few years ago than they are today. And so what's happening, though, is a lot of the stimulus is going into the coffers of the states for different spending programs. At the same time, this past year, a lot of the states' balance sheets looked better than they had anticipated they would have looked at the end of 2020. You add that to some stimulus that's going to be coming in, helping to support some of that, and I think you have a good scenario for municipal bond buyers and holders as well. And so we've been doing some of that. But I think, ultimately, really, the whether it's state or federal, it's going to be broken out through different projects, infrastructure, and so forth. So I'd like to turn it over to Mark. I know he's done a little bit of work this morning because there were some specifics that came out yesterday on the newest stimulus. So I wonder, Mark, if you wouldn't mind talking a little bit about the infrastructure spending and go from there. I appreciate that.
Yeah. It's funny, but when you have a breaking news over the night and then pulling together the information, sometimes it's difficult to find kind of what the breakdown of different stimulus is or different economic packages. And we're able to actually, we have a good resource here available through Dynasty called Bespoke, who was able to break down really what was in this infrastructure package at a rough outline of what is, they produced overnight. So I think broadly, when speaking about infrastructure spending, it's a bipartisan issue. Everybody wants to put it through. I think where it works into the stimulus, where we've seen over the last 3 packages, there's certain pieces within this infrastructure package that have been highlighted within a couple other of the stimulus package. So specifically in December, there was some money put towards clean energy initiatives. There's within each of the stimulus packages, there has been money put towards broadband access and building out the broadband. And those kind of hints you can use to kind of project out what's going to be in the infrastructure plan. And as you can see here, with the breakdown of the different areas, it's going to clean energy, getting about 400 billion. Clean drinking water also up there at 100 billion. And then you have, high-speed broadband again at 100 billion. So within the stimulus packages, there was infrastructure spending as well towards pieces of the economy that needed to be strengthened in order to, during the pandemic, in order to support the growth and support the amount of people that were online, for example, with the broadband spending. So just wanted to share this slide as I know it's information that came out overnight. I think it gives a good depiction of kind of where the money's going overall. But I think too, one of the major things that we've seen over the course of the last 3 stimulus packages has been spending on telehealth, which was a trend that started prior to the pandemic, definitely accelerated during the pandemic. And I think you're going to see it stick around for a significant amount of time post-pandemic in some way or form. And I know we want to throw up a poll here too. And after we throw up the poll, I'll talk a little bit more about healthcare because I think it is a significant development over the course of the last year.
Yeah, this is a healthcare related poll, a little bit interactive here. It's related to the vaccine. So it says, have you received or do you plan to receive the COVID vaccine? So again, it's anonymous. We're looking for, just to read from the group here, have a little bit of fun while we talk our investment stuff for you guys.
Yeah, while those results are coming in, and you can pop it up when they do. But I think for the purposes, not explicitly in the stimulus packages, but one of the major initiatives when the pandemic happened over the course of the last year was getting a vaccine. And the government was really taking on all the financial risk to make sure we had as much shots on net as possible in order to end up with, at this point, 4 different vaccines to choose from, 3 different vaccines to choose from, and a couple more towards the end of the pipeline. So the government was able to, and we got 100% yes, the government was able to fund those efforts and really took the risk off the companies. And what that allowed the companies within the biotech and pharma industries to do is really, without initial outlay of the resources, they were able to try different things. And what we saw was the first 2 vaccines that were approved use mRNA technology. And this was technology that was being developed prior to the pandemic, being tested. With the accelerated testing schedule, we were able to push that forward. And now you have 2 vaccines that use that technology. And I would imagine over the course of the next several years, we see opportunity to use that technology within different vaccines. And to build off that a little bit more, I would imagine there's a lot of companies within the biotech industry that tried things out that haven't been approved yet. But what they learned over the course of the last year is going to be used for the next several years. So I think you're really going to see sort of a revolution within the healthcare industry, and a lot of development of new vaccines, more effective vaccines, and so forth. And I think even past vaccines, different drugs. So Joe, I think seeing those results, it bodes well for the economy going forward and the reopening, specifically when you look at some of the more recent kind of headlines from the Pfizer and Moderna, where one shot is 80% effective, and then Pfizer came out yesterday and said, their vaccine is 100% effective for kids 12 to 15. These are significant developments, and I would imagine that it's going to help out economic numbers substantially over the course of the next year. Wondering what you're hearing on that front.
Sorry, guys, I think I lost you there. So can you hear me okay?
Yeah,
All
we
right.
got you.
All
yeah,
right.
just
Yep.
on the economic front, I think what I was saying, I don't know how much of that
I heard it. I heard it. The work from
All right,
home,
perfect.
it's good, guys, but it's not always perfect, right? As you have the internet connection coming through. Yeah, I mean, look, I think certainly we're seeing now upwards close to 3 million shots a day from the vaccine perspective, which can affect a couple of things. There's economic growth, which I'll talk a little bit about. There's employment, and there's inflation, right? I think inflation has been one of the big topics that is out there, and so certainly in the short term, as we think about the base effects as compared to last year, right, when we had a big drop in demand because of the pandemic, we're going to see some higher rates of inflation just based on base effects from last year. The question is, will that wind up being transitory, or will it rise over the coming years, such that we think the Fed would have to raise interest rates in order to contain it? Something that is relevant, which I mentioned before, the Fed changing their philosophy a little bit, saying that they'd be comfortable with inflation running a bit higher than their normal 2% target for a period of time, looking more for an average over time, where they can run a little bit hotter if they've been running below, which we have been generally for some time. So they don't want to prematurely tighten and choke off a recovery like they've done in the past. So I think some factors that argue for higher inflation in the more intermediate to longer term, the base effects we talked about, that's in the short term, but the huge amounts of fiscal and monetary stimulus that we've been talking about, the market has pushed up its inflation expectations as measured by break-even rates. So the market is thinking that inflation will rise higher than maybe the Fed is forecasting. We talked about some of the supply chain disruption, certainly just the economic growth and what that can do to prices. But there's some factors that would argue against inflation as well. One being unemployment was at 3.5% before the pandemic started, and there really wasn't a whiff of inflation at that point. And there can be some reasons for that: tech advances and automation, demographic trends, low fertility rates, aging populations. These are things that wind up putting downward pressure on growth and inflation. And years of lower inflation have caused people to feel like it might continue, and that can set in a motion of a cycle of expectations of lower inflation. And so I think from the inflation perspective, our view is that it'll move somewhat higher from here. But at least for this year, in the shorter and intermediate term, the Fed has the tools to deal with it. I think the Fed has seen the example of a country like Japan and realized that in the event that we do have inflation, as painful as that might be, because you might have to raise interest rates and stunt economic growth in order to do that, the cure for that is at least known and how to combat it. But the cure for deflation is not as clear. And so I think that's a big factor coming into the Fed's thinking. So I think they'll let inflation run up to say 3%. From there, they can raise rates or sell securities if they have to help fight it. So I think it's a growing concern with some of the reasons we talked about, but I don't think it's an urgent concern right now, as I think the Fed will have the tools to fight it. And then from a growth and employment perspective, forecasts are for anywhere from 5.5% to 8% real GDP growth in the U.S. this year, which that would be the fastest pace in this country since 1983. We should make up the output that we lost to the pandemic sometime this year in 2021. The market will probably take another year or two to get back to where it was from an employment perspective, though, as there's a fair amount of slack there, 9 million jobs lower than we were in February of last year. But the stimulus that we're talking about will certainly have positive effects on jobs. There's still a ways to go, before the pandemic, and we'll likely won't get back to that jobs number until say next year. but it's certainly going to have a push for strong economic growth this year. And I think it's something that the market's going to have to watch is inflation, and I think the Fed will be watching it. And there's a disconnect right now between the Fed and when they think they'll raise interest rates and the market, and it'll be interesting to see where it winds up playing out. But the stimulus can wind up being rocket fuel for the economy, as evidenced by those GDP growth numbers.
Yeah, no, I think that's good, all good points, and we have just a couple minutes left here, so I want to kind of wrap this up a little bit and kind of and bring it to a point. I think the trends, the way that we see it, are headed in the right direction for the most part. Obviously, commercial real estate is going to take a hit. But ultimately, we have millennials who were out of the housing market up until just recently, looking to buy housing for one reason or another. They have excess cash flow, they have low interest rates, they now have families perhaps, and perhaps that now they have nothing to do in the city, at least for a little while. And so we've got that happening. We've got continued, fiscal infrastructure spending, which I think helps with that unemployment number over the course of the next 1 to 2 years. We've pumped trillions and trillions of dollars of cash into the economy in order to bridge the gap between here and growth. And that's created some debt. That's created some global debt. Now, we were going to drill into this a little bit deeper, but maybe that's for the next webinar. But I think ultimately what we got to think about is we know all these good things I think are happening. The trends are fairly clear at this point. We're taking on some debt in order to bridge that gap. How does that debt get paid for? And I think that'll be, some of the next steps that we're going to have to really talk about. But ultimately, if it really is jet fuel and we have this vaccine that works, and just today I saw that Pfizer announced that there's 100% efficacy from children ages 12 to 16, I believe, and it continues to get better. All of that seems to bode well. And then you ask yourself, well, what about market valuations? Where does that leave us in the market? And so some of the valuations are stretched, obviously, but we did some work here, and Mark came up with some good information that I think will help frame that a little bit, which says that, the valuations at the top 20% of US companies are absolutely stretched. The top 20 most highly valued from a valuation standpoint are very, very stretched. However, the bottom 20%, the lowest valuation, are not far off their long-term average. And so we've got this broad dispersion between high valuation stocks and low valuation stocks. We couple that with debt and vaccines, and what that starts to look like to us is, okay, on the growth side, some of the demand has been pulled forward. On the lower side, on the value side, perhaps we've missed out a little bit, and that's waiting for a reopening. And so as we kind of go through this, we're looking at all these various sort of trends that are picking up. But for us, it kind of leads us to really an optimistic future. Certainly, we're going to have to go through some things over the next couple of years, and these trends may reverse. And some may stop altogether. But ultimately, we think that there's plenty of room here for opportunity. And we think that adding some stimulus, as we have in liquidity, as the Fed has, is really the key to kind of getting through it. And ultimately, we believe employment will come back in probably a shorter period of time than most people imagine. So I want to kind of just leave you with that. If you have any other questions, we went through this pretty quickly, and there are lots of other topics, and we'll do it again. But if there are some questions, please send them over to us. We can have Joe Dercy and his team, or me and my team here at Procyon, answer those. If you have questions for your advisor and you'd like to talk a little bit about it on your own, please send us a note. We're happy to do that. I just want to thank Mark Rich and Joe Dercy for joining us today. Thank you guys so much. You guys lent a lot of information to us and some great wisdom. And we hope you have a happy rest of the week and a good holiday.